Show you really quickly. Let's see. I'll go over here first. Let me share my screen with you. I want to show you. Just the stock market really quickly. What the stock market has done. This is just in the past 5 years, right? So you'll see here. We come here. We're at 24,000, 23,600. And then we go over here, we're at 32.8. So it's not quite 30%, but let's just call it 30%. This is what the stock market did. 30% in the past 5 years. 30% in the past 5 years. With that big dip, of course, that was COVID. But 30% in the past 5 years. You might be saying, well, Miles, that's a fantastic return. And you know what? It's not bad. 6%. That's 6% annualized, right? Compounding interest is probably a little bit less, but it's 6%. That's what it is. It's 6%. Can you do better in real estate? Absolutely. You saw that big dip and you had to wait. I don't even know how long you had to wait for here. So February 12th, let me share. I'm going to share this with you so you can see it. So you can see what I'm looking at here. All right, so right here at February 12th, we start to see our big dip from 29.5. It dips all the way down on, what is that, March 18th, March 20th, March 23rd to 18.5. That is a huge dip. So it took from March 23rd of 2020 just to get back normal. Let me see here. Just to get back normal. It took about 9 months to get back to normalcy. It took about 9 months to get back to normalcy. And then we just saw this boom. And when we're here at these double peaks, that means something in the stock market world. I don't know what, though. You'd have to ask somebody in the stock market. But that's what it did, 6%. Let's call it 5.5% compounded year over year. You can do better in real estate. Absolutely phenomenally better, right? But that's what the stock market did. Let me show you these CDs, because I know some of you have money in CDs and you put it there because you want it to be safe. It's not something that is as liquid as you want them. Yeah, you can go in and cash it out right away and pay whatever the penalty is for doing that. And if you have a penalty and you want to lend, borrow against it. Don't cash it out. The penalty would be too ridiculous. All right. So let me share with you what these CDs look like. Okay. So here's Capital One. This is one of the best, and they change daily. You have to know that they change daily. All right. 5%. Again, real estate can give you 8%. Now this is a guarantee. They'll say, look, you got $500 because there's no minimum deposit. It has to be in there for at least 11 months. And we're going to give you 5% a year, which means you're not going to quite earn the whole 5% at all. Go down here. What is this? Marcus by Goldman Sachs, 4.5%. Minimum of $500, 1 year. Citi or CIT, whatever that is, 4.65. Synchrony Bank, 5%. I know they change all the time. Ally, 5%. So Synchrony and Ally, just so you know, they're offering those higher interest rates because they do a lot of, I don't know, how do you call it? They lend a lot of money to people that have marginal credit, right? So the interest rates are a lot higher. So they pull in these deposits so they can loan them out, and they do credit cards, they do cars, they do that kind of thing. And they also have banks now. They're actual banks. So they're pulling in all this money so they can lend it out. They're paying you 5%. They're taking your money, okay? And they're telling you it needs to be in there for a year and a half, like Ally says it right there. That's how long it needs to be in there because they know how long it's going to take them to turn that money, okay? Ally is a big auto lender. They do a lot of other things, but they're a big auto lender. They are one of the lenders that lend at second chance car dealerships. Not the only ones. I mean, you can get them at big big car lots too, because they give people, really good interest rates on vehicles if you have the credit worthiness and so, you know the game. So going back to what I was saying here, they're going to take your deposit. They're going to pay you 5%, but they're loaning it out to people at 24%, 28%. You see what I'm saying? And they're getting these huge payments. And a lot of times they're, biweekly payments, but it doesn't matter. It comes in on a month. They're just huge, huge payments. Just think about that. They're paying 5%, but they're charging 25%, right? They're getting 20% on your money. On your money. That's how real this stuff is. All right. And so it looks like, oh man, 5%, 4.65%, 4.5%. It looks all great. And then we get into what the real numbers are, because again, these are, Sally Mae. They're not going anywhere, right? So you have to know what it is you're trying to get into. 4.5%, it's not really nuts. Wells Fargo's only paying 1.5%. And as you, let me see, if we just do more, look at Bank of America is paying 0.03%. Chase is 0.01%. So we've got a lot of them that are in the fours. It just keeps going down. That's where we are right now, because they have to have some incentive to bring people in. And believe me, when I was looking at this Friday, there were numbers that were very, very different. As I told you, they change on a consistent basis. By the way, let me tell you, the Fed meets this month. I don't know when. I can't remember when, but it's inevitable that interest rate's going to wind up going back up. So be aware of that. Okay. Be aware of that. Now, you saw what CDs pay you. You saw what real estate does, right? I showed you what the Dow Jones did. You're at 6%, 5.5%. Same way you are here in your CD, but the CD has more of a guarantee on their 5% as opposed to the 5 or 5.5% that the stock market is doing. There's no guarantee, right? So I want to show you real estate just over the past few years. So look here. Home prices continue to rise as supply dwindles, which we're seeing. So we go down here and we can see from 2017 to 2022, this was the end of 2022. So this is, housing. The values just go up. These are just values. I didn't want to get into actual inventory reports. I just wanted to show you the values, right? The values just went up from 2017. They just went up. And we know that even at 2017, those numbers were even higher than they were 5 years prior to that, from 2012, because what we were coming out of, right? We were coming out of the financial crisis. We were coming out of the worst recession we've seen since the Depression. And that's real. That's what that is. And home prices over the past 15 years have just gone up, and up. There's been a couple dips here and there, but this is where you want your money to be. And lastly, let me share this chart with you. It's not a chart, actually. It's an article. And this article was written by a government agency. I can't remember which one. I just took a screenshot so I could share it with you, but I'll pull it out and find it. House price change 10 years in the United States. So in 10 years, you'll see here, and I don't know if you can see that well, but there's been a 109.45% increase in value over the past 10 years. Even Canada's had 99.94% increase in value over the past decade. That is absolutely incredible. It's just incredible. Those are numbers that are just insane. Those are real numbers, though. And that's why I'm telling you, if you want to become a private money lender, this is where you start. This is where you start. You say, look, man, I need to readdress what I'm doing with my retirement account and how I want to do this. Well, there's different things that you need to do. You have to talk to a fiduciary. Depending on what it's in, IRA, 401k, you're going to invest through a fiduciary, into that. You can also borrow against it. If you're happy with the returns that it's making, you'll wind up paying yourself about 4% interest, which is nothing, but you're paying you. Okay? You're paying yourself. Now, that fiduciary is going to also get a piece of that. Let me just put that out there. So if you're paying yourself 4%, they're probably going to get 25% of that just for facilitating it. All right? So there's different ways for you to go about it. You just have to have a conversation with people that can steer you, give you the right information and steer you in the right direction, to talk to people that can absolutely help you out with whatever your situation is. Okay? But I think that it's important, especially in the climate that we're in today, I think that it's important for you to take full advantage of whatever resources you have. We've got people that took out loans, literally took out lines of credit to be private money lenders because they were getting loans so cheap. They're not doing it so much right now, but I mean, a regular line of credit. Some people took out HELOCs to do it. You know, they borrowed against, I mean, we've done it. You know, every so many years we refinance our properties and we wind up with a chunk of money that we need to reallocate. So some of that goes into more assets. Some of it goes into some of the lending stuff that we do because it keeps the money turning. You know, it has to be in motion. It has to constantly be in circulation, because if it's not in circulation, you fall victim to inflation. Okay. I know that a lot of people like to look at their money sitting in the bank and they like to look at their commas and their zeros. Hey, that's great. Cash flow is better than cash, man, because you can leverage cash flow as well. We live in America, okay? And I know that as a business person, utilizing leverage, debt, helps you out. As an individual, listen to Dave Ramsey, all right? I mean, as an individual, you want to be debt-free, right? You don't want to have the weight of everything on you. But as a corporation or whatever business entity you are, debt is your friend. It's the only way you're going to get ahead, unless you win the lottery. But even then, you're going to take out loans. You're going to take out loans. You just kind of have to. I mean, you can spend your cash, but then you're banking on something that's inevitable. So you leverage it, right? You could take $100,000 and leverage that into $500,000 in a month's time, 45 days time, for real. You just have to know how to do it. I'm giving you everything you need to find success as a real estate investor. So make sure that you subscribe to this channel and like this video. See you later.